Our discussion will continue with finance success. We explained last week the importance of this topic to us as finance manager. We must understand the difference or the various finance success, the various sources of finance available to the business organization. All right, let's go on. So we explained precisely, we focused on equity finance success last week. A quick recap of our last discussion, that equity financing, this is the money contributed to the business by the owners of the business. The owners of the business are the equity shareholders. In other words, equity finance refers to finance that is contributed to the business by the owners of the business. Under equity financing, we discussed retained earnings. Retained earnings is part of the equity earnings. Earnings attributable to equity shareholders. Retained earnings is that percentage of equity earnings that is retained in the business and reinvested for future growth. Company can adopt retained earnings as a source of financing. We explained this last week. We tried to explain the benefits of financing business with retained earnings. We equally explained some of the limitations with retained earnings as a source of financing. Later, we move to the issue of new shares so as to raise finance for the business. There are three ways company can issue new shares in order to source finance. There are three ways companies can issue new shares in order to source finance. One, we talk of public offer, otherwise known as offer for public subscription. Public offer, issue of new shares to the general investing public. Under public offer, the company in question will issue new shares to the general public. And we explained that only publicly quoted companies are allowed to do public offer. Private companies cannot do public offer. We explain this. We explain private placing, issue of new shares to a relatively small number of selected investors. We also explain right issue. We now dwell more on right issue. We explain that right issue is the issue of new shares to existing shareholders, usually at a discounted price, so as to raise additional finance. Sorry, I had a temporary network glitch. I was trying to explain issue of new shares. New shares under equity financing. And I said there are three ways company can issue new shares in order to source finance. One is public offer. Under public offer, the company issue new shares to the general investing public so as to source additional finance for the business. And we mentioned that only publicly quoted companies are allowed to carry out public offer. I explained private placing, issue of new shares to a relatively small number of selected investors. Under private placing, the company in question will place its new shares with a particular stockbroker. It is the stockbroker that will now look for buyer for the product, for the new shares. Issue. Right issue is the issue of new shares to existing shareholders, usually at a reduced price or at a discounted price, so as to encourage the existing shareholders to subscribe for the new shares. And we emphasize that company can use rights issue as a source of financing. Thereafter, we dwell more on rights issue. We try to explain the issue price. The issue price, this is the price of the new shares in a rights issue. This price is usually below the current market price of the existing shares. We equally discuss theoretical ex-right price. The theoretical ex-right price is the expected share price after the completion of the rights issue. Let's explain that briefly. If a company carries out rights issue, that company must have shares in existence. For you to do rights issue, the company must be publicly quoted company. That means the company in question have shares in existence. And the existing share will have a price. Now the company will now issue new shares via rights issue, through rights issue. The new shares will be at a reduced price. Now, after the completion of the rights issue, we now try to forecast the expected share price after the completion of the rights issue. The theoretical ex-right price is the expected share price after the completion of the rights issue. This is what the share price ought to be after the company has completed the rights issue. And this is calculated as the weighted average value of the existing shares cum right price and the issue price of the new shares in the rights issue. We explained this. We discussed the options open to shareholders in a rights issue. Thereafter, we were able to solve 2 questions on this topic. All right, we have tried to do a recap. The next 10 minutes or the last 10 minutes has been spent doing a recap of our last class. Any question, please? We shall be looking at illustration 1 today, BJPSC. That is illustration 1 in your study pack, page 142 or between 142, please check. We shall be looking at this question tonight. BJPSC. Please let us refer to the study pack. I'll read, please, just 1 minute. Please, just 1 minute. I'll be back. Let me quickly. All right, let's go on with the class. I'm sure we are on that page 142, 143. I'm not sure of the page, but it's question number 1. I'll read.
Page 138.
Oh, thank you. Page 138. All right, let's go on. BJPSC is a medium-sized manufacturing company which is considering a 1 for 5 rights issue at a 15% discount to the current market price of 4 naira per share. Issue costs are expected to be 220,000 naira. And this cost will be paid out of the funds raised. Please note that the issue cost, that is the cost of issuing the rights issue, is 220. And this cost will be paid out of the funds generated from the rights issue. It is proposed that the funds raised from rights issue will be used to redeem some of the existing debentures at par. Also note that it is proposed that the funds raised from the rights issue will be used to redeem, that is to repay some of the existing debentures at par. Financial information relating to BJPSC is as follows. Statement of financial position. Non-current assets, we are giving this information. You have the current assets, inventory, receivable, cash, total assets, our current liabilities, trade payables, overdraft. Then we have non-current liability, 12%, 12% debentures, 4.5 million. The ordinary share is 50 kobo per value. Total nominal value 2 million naira. We have the reserves. Information. The price earning ratio of BJ is 15.24. Overdraft interest rate 7. Income tax rate 30%. Sector average. Debt to equity ratio in bracket book value is 100%, and interest cover ratio is 6 times. Requirements. Requirements A. Esang, please can you mute? On the background, that thing is coming in. Thank you. Requirement A. Ignoring the issue cost and any use that may be made of the funds raised by the right issue. Calculate, Roman figure 1, the theoretical X right price per share and the theoretical value, and value of the right per existing share. So let's take requirement A first. Requirement A says A1, calculate theoretical X right price per share. A Roman figure 2 says value of the right per existing share. Let us deal with this first. So remember, what is theoretical X right price? And how do we calculate theoretical X right price? That is the expected share price after the completion of the rights issue. The expected share price after the completion of the rights issue. So we can start our computation and pick my pen. A1, we have to calculate theoretical X rights price per share. Okay. You open our schedule. You have your item. You have your quantity. You have the price. And you have the value. You start with your existing shares. Existing shares. Then you talk about your new share. New shares. Now let's go to our working. The right issue arrangement says, can bring this down small. Our working. We have right issue. Right issue 145. That means for every 5 existing shares, we are going to issue 1 new share as rise. So you can do like this. Existing shares, quantity 5. New shares 1. Now, what is the current market price of existing share, please?
4 naira.
Thank you. The current market price is 4 naira. I'll pick that 4 naira. Now, what is the issue price of the new shares in a rights issue? Examiner says at a discount of 15%. Can we see that? Can we all see that?
Yeah, 3 naira 40 kobo.
So first, we consider 15% discount. That means you are going to compute 15% of 4 naira. Discount 15% from 4 naira. So the discount becomes the discount is 15%. Please compute 15% of 4 naira. That will give us
3.4.
no 15% of 4 naira first.
0.6.
0.6. Because some might not know how you get your 3.4. You now deduct 0.6 from here now. So I have to try to get, some might not be able to understand how you are getting your 3.4. 4 naira minus 0.6. This becomes 3.4. That means the issue price of the new share is 3 naira 40 kobo, 3.40. Now please multiply. 5 multiplied by 4. Value here is 20 naira. 1 multiplied by 3.4. Value here is 3.40. Now get your total. This is 6. This will give us 23.4. So you can calculate your theoretical ex-right price. Theoretical ex-right price is equal to total value 23.40 divided by total quantity 6. What do you have here, please?
3.9 kobo.
3 naira 90 kobo.
9 kobo.
It's 90 kobo. 3.9 is 3 naira 90 kobo. This is the theoretical ex-right price per share. Now, let me quickly say that you can also use total approach. We have used like individual shares here. I can also compose my theoretical ex-right price in this form. Theoretical ex-right price. I have my item, my quantity, my price, my value. I'll take the existing shares. I have the new shares. Okay, let's go to this. Now, what is the total number of existing shares? Please check the financial statements. Total,
2,000.
that is
2 million.
Total number of existing shares The naira amount is 2 million naira. The total nominal value, the book value of our share is 2 million. Price per share, nominal price per share is 50 kobo. Is that not, please?
Yes, sir.
If you look at examiner says share capital in bracket 50 kobo per share per value. That means the nominal value per share is equal to 50 kobo. And that 50 kobo is same thing as 0.5. So to get total number
That's the
of
nominal
shares,
value.
to get total number of shares,
Want to be
2
listening to
million
this thing
divided
again.
by
I need to finish.
0.5.
This May has to come, June has, I mean, whatever, it has to come and go.
To get total number of shares, total naira amount divided by 0.5, value per shares.
4 million.
Thank you.
That's 4 million shares.
Thank you. Total number of shares in this company, total number of existing shares is equal to 4 shares. Let me change this. This might create confusion. I will call this share capital. This is share capital. Okay. So total number of shares in this company, existing share is 4 million. I can come back here. Total number of shares, quantity 4 million. Market price per share, per existing share, 4 naira. Total value here, 4 million multiplied by 4 naira. That should give me 16 million. Is that not, please?
Yes, sir.
Great. Now, we now want to determine number of new shares. Number of new shares, we can come here. Number of new shares. Examiner says right issue. Right issue. 1 for 5. That means for every 5 existing shares, we are going to issue 1 new shares as right. Now, if you have 4 million shares in existence, what is the total number of new shares?
800,000.
That becomes 1/5 multiplied by 4 million existing shares. That means new shares is going to be 800,000. Total number of new shares is 800,000. You can also come here. Come here. This becomes total quantity for new shares, 800,000. Issue price, 3 naira 40 kobo. Please multiply. 800,000 multiplied by 3.4. That should give you 2 million.
2,720,000.
Now add your quantity. This will give me 4,800,000 shares. Add your value. This will give you 18,720,000. Now calculate the theoretical ex-right price. That becomes our theoretical ex-right price is equal to total value 18,720,000. Oh, let me go down, please. Squeezing this thing make no. I didn't leave enough space.
Excuse me, sir. I'm just curious. You know, we calculated the TEP as 3.9. If we had applied that 3.9 on the, won't we get the same answer instead of the full calculation all over again? You know, we calculated it per unit. I'm just curious.
I didn't get that part. I didn't get that part you are trying to see. If we multiply 3.9 by what? Yes, Musa.
The TEP here, 18.72 divided by 4.8. I think we'll get the same 3.9. Maybe I'm mixing up 4.8.
Look at the theoretical aspect, but let me just finish. You can now make your comment.
Okay.
720 divided by 4,800,000. Please compute. What do you have?
3.9.
Now, why take the two approaches? First, that's the first one we did. At times, the examiner will just give you information about the right issue only. Examiner will not give you the company financial statements. Like the question we solve on Balama. The question on Balama, you can only use that first approach. The question on ZY, you can either use the first or second approach. You are still going to get the same thing. But why am I bringing the second approach here? It's because it's going to have impact on my other calculations. I want to know the amounts generated from the right issue. Look at it. I've brought the second approach, not because I want to consume our limited time, but because I know that I'm still going to require this later on in my computation. What it means is that the amount generated from the right issue, the total amount of money generated from the right issue is 2,720,000. Instead of trying to recalculate again, I've made provision for this because I'm going to require it in my subsequent calculation. Is that clear, please? Both method or approach will give you the same value. But I'm aware that requirements B, I'm likely to this amount generated from the right issue. Is that clear, please? So we can move on if there's no other. We are done with the A part of this question. No, A1. Now, A2. Examiner says calculate value of the rights. Value of the rights per existing shares. Now, what represents value to you? What is the value of the rights? Value of the rights to the investor is the gain or the profit from the rights. Value of the rights to the investor, it is the profit you derive from your rights. Now, what is this profit? As an existing shareholder, you can buy the new share for 3 naira 40 kobo, 3.4. as a shareholder, this right, you can buy a new share for 3 naira 40 kobo. After the completion of the right issue, you can sell for 3 naira 90 kobo. That is the expected share price. What is the value to you? What is the gain? Hello? Yes. You can buy a share for 350 kobo. Thank you. And after the completion of the right issue, the share price is expected to be 3 naira 90 kobo. What is the value to you? The gain is, look at it. To calculate value of the right per existing share, you can calculate as theoretical X right price minus the issue price divided by number of existing shares in a rise. Please note this. Number of existing shares in a rise. Our theoretical S right price is 3 naira 90 kobo. The issue price is 3 naira 40 kobo. What is the number of existing shares in a rise? We said 145. Is that not? The right issue says 145. For every 5 existing shares, that means 5 shares in a right. For every 5 existing shares, we are going to issue 1 new share as right. Existing share in 1 right is 5. You now divide by 5. 5 shares. If you calculate this, you are going to have 0.5 divided by 5. That means the value of the right per existing share is 0.1. That is the value of the right per existing share. Now, let me also say that the examiner can ask you to calculate value of the rights per new share. The examiner can also add something like this. Look at it. Assuming I want to do A3, value of the rights per new share. This becomes theoretical S right price 3 minus the issue price 3 naira 50 kobo 40 kobo divided by how many rights? 145. That means 1 new share. For every 5 existing share, then we are going to issue 1 new share as right. In this case, you are going to divide by 1. Your answer becomes, this becomes 0.5. This is the value per new shares. 0.5 is the value per new share, while 0.1 is the value per existing share. I hope this point is clear. I hope this point is clear.
Yes, it is. The way you explained it now, it is.
Yes,
Thank
sir.
you.
All right. We move to requirement B. Calculate the current
Hello,
earnings.
sir. Hello, sir.
Yes, please.
Hello. Please, if what about if the theoretical S price is lower than the issue, as in you make loss, is it the same procedure?
The theoretical strike price cannot be lower than the issue price. Let me repeat my point. Your theoretical strike price cannot be lower than the issue price of the new shares unless there's error in your computation. Unless there's error in your calculation. That's fine. That point is taken.
Yes, sir. Thank you.
We can move to requirement B. Calculate the current earnings per share. And the revised earnings per share if the proceeds of the right issue are used to redeem some of the existing debentures. We need to try to interpret this question out now. Examiner says we should calculate the current earnings per share. That is the earnings per share before the right issue. Before the right issue, what is the company's earnings per share? Then we now have the revised earnings per share. If the proceeds of the right issue are used to redeem some of the existing debentures, that becomes the earnings per share after the company has carried out right issue. We have generated the proceeds from the right issue. We now use this proceeds to repay our existing debentures. So what is the revised earnings per share after the completion of the right issue? And the proceed is used to repay the existing debentures. So I've tried to explain the requirements. So how do we calculate earnings per share, please?
Share
How do
price
we
divided by
calculate earnings per share?
share price divided by price earnings ratio.
Share price. Share price. Is that to calculate? Is that how to calculate?
Divided by ordinary shareholders. Ordinary shareholders.
So normally
Or it can
our
still be profit after tax divided by
yes, that is the profit after tax divided by number of ordinary shares.
number of ordinary shares, yes.
If there is no present dividend. But in this question, we don't have the profit after tax directly. But examiner gave us price earning ratio. We can use this to derive. We can use this to derive our current earnings per share. Let's go to this. I can do like this. My B now, also B, we have two questions in B. B1 says, calculate current earnings per share. I'm giving price earning ratio. The price earning ratio to be 15.24. Our price earning ratio is market price per share divided by earnings per share. Examiner say this is currently 15.24. I'm trying to derive earnings per share. Good enough. We know the current market price per share is what? The current market price per share is 4 naira. Is that not? So I can replace this with 4 naira divided by EPS is equal to 15.24. What is earnings per share? We can cross multiply this now. That means my earnings per share is equal to 4 naira divided by 15.24. Please work this out. What is the earnings per share?
0.20.
262. 0.262.
0.2625. Is that not? Is that not, please? That means currently the earnings per share is 0.2625. You are done with that. We now come to the B2. We have B2. Revised earnings per share. If the proceed of the rights issue are used to redeem some of the existing debentures. That means I want to know, after the company has completed its rights issue and we have repaid the existing debentures, what is our revised earnings per share? The earnings per share after the completion of the rights issue. You can approach it this way. You can approach it this way. First, determine the current profit after tax. The current profit after tax. We can compute this. The current profit after tax, we can calculate this. Look at this, please. I just want to move down a bit. I want to show that working. Remember that earnings per share can be calculated as profit after tax less preference dividend. In this case, no preference shares here, divided by number of ordinary shares. Okay, we have calculated this. Our current earnings per share is 0.2625 is equal to profit after tax. I don't know. I'm trying to derive currently. Then number of ordinary shares currently is 4 million ordinary shares currently. I can derive my parts. My profit after tax is equal to, just cross multiply, 0.2625 multiplied by number of existing shares. What is the current profit after tax? This will give us 1,050,000. Please check that out. Is that not, please?
Correct.
That is the current profit after tax. You can return back. Currently, the profit after tax is 1,050,000. Now, how much are we going to generate from the rights issue? How much are we going to generate from the rights issue? Look at it. Come here. Gross fund for rights issue. We are going to generate 2,720,000. That was the second calculation I tried to show. In exam, you only need to do one. Oh. In exam, I would have expected you to use the second approach because you require this figure for your subsequent calculation. This is the funds generated from the rights issue. Now the question says issue cost is 220. The issue cost is expected to be 220,000. And this will be deducted from the proceeds of the rights issue. Is that not, please? Look at the first paragraph. Can we all see it? Hello.
Yes, sir, we can see it.
Please, the only way I will know that the class is running
Yes, sir.
is I'm also having contribution from the students. If you look at it, examiner says the issue cost 220 will be deducted from the funds generated. Come here. Less issue cost. This is 220,000. That means we are left with what?
2,500.
We are left with 2,500,000. This is the net funds. Net funds raised. Now, what will the company do with this money?
Settle the debenture.
Thank you. Examiner says,
Certainly.
thank you. Examiner says The proceeds of the rights issue will be used to redeem some of the existing debentures. Now the question is, if you repay your debt, what will happen to your interest expense?
Reduce.
Your interest expense will reduce. Is that not?
Yes.
Good. If your interest expense reduces, what happened to your profit?
Reduces.
No. If
Increases.
your
Increases.
interest expense reduces, what happened to your profit?
It increases.
Good. Your profit will increase. If your profit increases, what happens to your tax payment?
Increases.
Tax
Then,
increases.
please, you are going to do three things simultaneously here. If the company repay its debt by 2.5 million, that means interest will be saved. Look at it. I'll just come here. Interest saved. Interest saved. By repaying our debt by 2.5 million, that means the company will not pay interest again on the 2.5 million. By repaying your debt by 2.5 million, that means you are not going to pay interest again on that 2.5 million. That is called interest saved. What is the interest on debentures, please? 12%. Is that not?
Yes.
Please compute 12% of 2.5 million.
300,000.
That means the interest saved is 300,000. It also means that the profit will increase by 300,000. If your profit increase by 300,000, then you need to pay tax on that increase in profits. You now come here, tax effect. What is the tax rate in this company? 30%. Please compute 30% of 300,000.
90,000.
That means out of this 300,000 interest saved, your profit will increase by 300,000. You need to pay tax of 90,000 here. You now have, look at it, and you can now get the revised profit after tax. Revised profit after tax. That is profit after tax after the completion of the right issue. The current profit after tax, 1,050,000 plus 300,000 less 90,000. Please compute your revised profit after tax. It should give you
1,260.
That is the profit after tax after we have completed the rights issue and we have repaid some of the debentures. And good enough, revised number of ordinary shares. Look at that calculation of theoretical right price. You see the second option. Let me take you there slowly. And look at it. Yeah, no, even look at it. Yes, don't go far safe. Where is that calculations? Yeah, look at it. I want to take you here. Yeah, this is where I'm going to. After the completion of the right issue, total number of shares become 4,800,000. Is that not, please?
Yeah.
Yes, sir.
So that means revised number of shares. When we say revised, after we have completed the right issue, what is the number of ordinary shares? 4.8 million. I can go back now. Can come here. Can come here. I can just come here. Revised number of ordinary shares is equal to 4,800,000. What is revised earnings per share? Your revised earnings per share, you can compute. Look at it, you can come here. Revised earnings per share is equal to revised profit after tax, 1,260,000 divided by, no, it's already crossing it. Divided by revised number of ordinary shares, 4,800,000 shares. Please compute. What do you have? 0.262.
2625.
Please note, it was just coincidence. It was just coincidence that we have both the current earnings per share and the revised earnings per share having the same figure. We are done with the calculation of B parts. We are done with the calculation of the B part. Requirement C. Can somebody read? Or let me go there and even read. Don't worry. Let me go to the question. This question is more involving. Requirement C. Evaluate whether the proposal to redeem some of the existing debentures will increase the wealth of the shareholders of BJ, assuming the price earning ratio of BJ remains constant. How do we go about this? Evaluate whether the proposal to redeem some of the existing debentures will increase the wealth of the shareholders of BJ. What represents wealth to shareholder?
Profit after tax.
Dividends, appreciation of the shares.
Good. Please note, what represents wealth to shareholder is actually dividends and appreciation or growth in share value. Although, if I put it well, please. That lady said profit after tax. No, dividend is also derived from your profit after tax. But if you put it in proper perspective, what constitutes wealth to shareholder is the dividend received and the growth in share value, appreciation of share price. So we go back to this. If you look at this right issue, the expectation of the shareholder is that after the completion of the right issue, the share price should be 3 naira 90 kobo. That was the computation under theoretical X right price. I will take that again. The expectation of the shareholder is that after the completion of the right issue, the share price should be 3 naira 90 kobo. That is the expectation. Now, if after the completion of the right issue, the share price, the actual share price, happens to be below 3 naira 90 kobo, that means the weight of the shareholders has fallen. Hello. If after the completion of the right issue, the actual share price at the stock market happens to be below 3 naira 90 kobo, it implies that the weight of the shareholder is reduced. But if after the right issue, the actual share price is above 3 naira 90 kobo, that means the weight of the shareholder will increase. Because we are expecting the price to be 3 naira 90 kobo. After the completion of the right issue, we now observe that the price is above 3 naira 90 kobo. That means we are receiving a value above our expectation. In that case, the weight of the shareholder will increase. Now, to be able to answer that part C, we need to calculate the actual share price after the completion of the right issue. Now, coming. After the completion of the right issue, the actual share price will be, look at it. Now, if you go back to requirement C, examiner says, assume that the price earning ratio remain constant. That means after the right issue, the price earning ratio remain unchanged. I can revised price earning ratio. When I say revised, that is after the right issue, the price earning ratio is still 15.24. Sorry. Our revised price earning ratio is calculated as revised market price over revised per share. This is equal to 15.24. And good enough, we have calculated revised price earning ratio. Revised market price divided by our revised price earning ratio is calculated as 0.2625 is equal to 15.24. What is the revised market price per share? What is the revised per share? $625 multiplied by 15.24. What do you have, please? That will give you 4 naira approximately. That share price is 4 naira.
He is also a coincidence.
Of course, we should expect it to come because we have the same price earning ratio.
It's a coincidence.
Yes. Because
So
I'm
in
not
an exam setting,
like this.
in
What
an
did you
exam
say?
setting, if someone were to encounter this question, there will be self-doubts. Because when you now get your revised market price, just like before, you get your revised EPS, just like before, you think that you are doing the wrong thing.
Listening.
I might be tempted and touch something that is already correct.
You might be tempted to say, am I sure I'm right, Abby?
Exactly. I'll be doubting myself for sure.
That's where if you understand the question, you are much at ease. This question was first tested in 2016. I think 2017, so I'm not sure. It was repeated in 2021 thereabouts. Or 2021 or 2022 was repeated. Examiner now tweaks he now introduced new variables to it. Because students could not attempt the first one very well, I cannot return it again. Ratio will not change. That means after we have completed the right issue, the price earning ratio is still 15.24. And we are share after the right issue. That means I can get a value per share after the right issue. Value per share after the right issue is 4 naira. And our expectation is it should be 3 naira 90 kobo. No. Look at it. This is value per share after the right issue. That is actual share price is 4 naira. Theoretical ex-right price. That is the expected share price should have been 3 naira 90 kobo. What has happened to the wealth of the shareholders? Increase in wealth 0.1. The wealth of this shareholder will increase by 10 kobo per share after the completion of the right issue. You can now make your comments. Your comment will now be if the price earning ratio remain unchanged, the actual share price after the right issue will be 4 naira. Therefore, the wealth of the shareholder will increase by 10 kobo per share, as shown in the calculation above. Excuse me. Any question, please? Any question, please? It's like this one is Okay. Maybe what we try to do is to try
My
to.
question would be that in the question, there's no information on dividend payouts or potentially so that means the increase in wealth is only related to the appreciation of the market price after based on the
Thank you.
right issue.
That was why I tried to ask. What constitutes wealth to shareholders? Two things: dividends and growth in share price. So because of this growth, 10 kobo growth in share price, that is what indicates or what confirmed to us that the wealth of the shareholder will increase. So please, let's try. Huh? Now, the deep part of this question. The deep part of this question. Please, let's try. Some question will come to you very simple. Some will come and we challenge you. You just have to try as much as possible to step up the game. Oh, excuse me, the deep part of this question. Examiner says, discuss the reason why rights issue could be an attractive source of finance for BG. Your discussion should include an evaluation of the effect of rights issue on debt to equity ratio and interest cover ratio. What can we take out of this requirement? Assuming you have to attempt this question, how do we go about this? Discuss the reason why rights issue could be an attractive source of finance for BD. Your discussion should include an evaluation of the effect of rights issue on the debt to equity ratio and on the interest cover ratio. Yes, I want to hear from the student. If you have to respond to this requirement, how will you respond to the examiner here? The line is open. Yes, please. We are waiting. Maybe I should just check name self.
Are there three questions here? One is right issue should be attractive source. That can be answered as theoretically. Then they said the evaluation of the effect of the right issue on the debt equity ratio. Beyond the calculation, why is it an attractive source? I think you touched on it last week. Was it last week when you introduced these sources of finance about the attraction to right issue as opposed to IPO, etc. When we said that right issue is open to existing shareholders, the shareholding structure does not change. You can raise cash without upsetting the shareholding structure. So shareholders will still have their same proportion of shareholding in the company. And it's also an attractive source because it's equity. So there's no debt involved. How will it affect debt equity ratio? It's going to reduce the debt equity ratio because the equity is going to increase compared to the debt. So it's going to get lower. I know you are going to calculate it for us to see it, but debt equity ratio is going to get better because the equity is going to increase. Then for the interest cover, I think the interest cover is going to get better because if the funding mix is now more in favor of equity, that means part of it, maybe part of the debt to be paid, there will be interest savings. And based on the interest savings, earnings will go up. That increase in earnings will now, of course, boost the interest cover. But the calculation will prove whether it's correct or not. That is my opinion, sir.
Oh, okay, in fact, it is that concluding part that you actually hit the right one. First is, you cannot discuss in isolation. Examiner says your discussion should include an evaluation of the effect of the right issue on debt to equity ratio. That means if you are to respond to this, you are going to look at it before the right issue. What is the company's debt to equity ratio? That's okay. After the right issue, what is the company debt to equity ratio? We cannot be able to look at the impact of right issue on debt to equity ratio. All things being equal, it should reduce the level of financial gearing, and that will reduce the financial risk of the company. That makes right issue an attractive source of finance. We can use it to reduce our financial risk. So you are going to look at, prior to the right issue, what is the company's debt to equity ratio? Then after the right issue, what is the company's debt to equity ratio? The same applies to interest cover ratio. So you actually answer correctly at the concluding part of your statement. You don't even need to start writing dilution or no dilution here. The major point is I want to look at the impact of right issue on two things. One is on financial gearing, debt to equity ratio, and on interest cover. All right, let's go to it. May God give us a better understanding. As much as possible, it's always good to understand the requirements. Maybe you try to explain to yourself, so that even if you are writing, you are still within the content or the content of that answer. Okay. All right, now go to deeper. Excuse me. Requirement D now. First, I will calculate current debt/equity ratio. How do we calculate debt to equity ratio? Do we include overdraft or not? Do we include overdraft when calculating our debt to equity ratio or not? Or we only include long-term debt? Normally, we don't include overdraft. We only focus on long-term debt. But in reality, if you are looking at your gear, overdraft is part of your borrowings. It's also a debt. So we are going to look at two scenarios. You are going to look at debt to equity ratio without overdraft and debt to equity ratio with overdraft. So I can come here. I have my 30 up. I'll start with our debts. We have debentures. What is the value of our debentures currently? Our debenture is 4.5 million without overdraft. With overdraft, it's also 4.5 million. Net overdraft. Here we say without overdraft. So we need this place. What is overdraft value? Please check the statement.
1 to 50.
How much?
1,250.
So our total debt, no, you should be able to straight my hand. Now say total debt. If you say without overdraft, that becomes 4.5 million. With overdraft, this becomes 575,000. This is the debt. You now go to the equity. Now, remember when we're doing capital structure and theory of gain, we said you can calculate your gearing using market value approach or book value approach. In this question, the examiner wants us to use book value. How do we know? We are giving sector average, debt to equity ratio in bracket, book value. If you look at it, you have sector average towards the, after the statement of financial, after that statement of financial position, financial information, you now have any price earning ratio, you have interest on bank overdraft, then you have sector average, okay, you have the income tax rate, you have sector average. You observe that in bracket, they now say book value. That means sector average is given to you in book value. The industry sector average is calculated using book value approach. If you now want to calculate for BJ, you're also going to use book value approach. So you can compare BJ debt to equity ratio with the industry sector standard. Both will now be in book value approach. Now come here. For our equity, we start with the share capital. The share capital value is 2 million. 2 million. Then you now introduce reserve. Please note, If you are calculating your gearing using book value approach, it's calculated as debt divided by shareholders' fund. Debt divided by shareholders' fund. Shareholders' funds include the share capital and the reserve. So the reserve here, our reserve here is how much, please? I think 1,500.
Yes.
1,500. You can now get total equity funds. That is total shareholders fund. Total equity funds. This is 3,500. This is 3,500. You can now compute your debt over equity now. You can now compute your debt. Come here.
Excuse me.
Yes, debt over equity multiplied by 100. The first one, 4,500 divided by 3. So what is this percentage here? It should be like 129%.
1.1. Yes.
Multiply by 1, this is like 129%. What do you have here?
Yes, 129. 164%.
164%. This is the debt to equity ratio of the company currently, with or without overdraft. Now, what is the sector average? What is the industry standard? Examiner says sector average.
%700.
Yeah. Sector average is 100%. So what can you say about this company? What can we say about BJ? Sector average is currently 100%. What would be your comment about BJ?
They are highly geared.
Thank you. Currently, BJ PSC is highly geared above the industry standard. Look at the comment. If I'm to comment on this, my comments, BJ PSC is currently above the industry standard of 100%. The company is highly geared the company can use rights issue to reduce its level of financial risk. Financial risk. In this case, rights issue is attractive. In this case, rights issue would be an attractive source of finance to BG. You are now responding now. Reasons why rights issue is attractive can be used to reduce the level of financial risk of a company. So your explanation will not be in isolation. You are going to do some computation, and the computation has been given to you. Examiner has given you a guide: debt to equity ratio, interest cover ratio. So we have looked at before the right issue. Let us look at after the right issue. What is the company's debt to equity ratio?
No food.
Please help us to mute. So now come here. Revised debt / equity ratio. If the proceeds of the right issue are used to redeem some of the existing debentures. I will now come here. I want to calculate revised debt to equity ratio. That is debt to equity ratio after the right issue. I'm going to look at without overdraft, I will also check with overdraft. We come here, our debt I will now start. We start with the debt. We have debentures. Debentures value was 4,500. Is that not? We now repeat. We are going to repay debentures. How much are we going to use to repay debentures?
2.5.
Thank you. Into repay debenture by 2.5. So that means less 2.5. Less 2.5. Debenture value becomes 2.500. That means debenture value becomes 2 million. 2 million. They will now introduce overdraft. Overdraft, this becomes no overdraft here. Overdraft is here. That means the total debt, this is 2 million. This is 325. This is the total debt. We now come to the equity. Our debt has reduced, but equity has also increased now. We have issued more shares, have we?
Yes.
Our share capital before was 2,000. This will increase by 2.5 now. The share capital becomes 4.5. You are bringing it up. I didn't even know that the network is gone, Seth. Let's try and round up the question. Total equity funds. This is 6,000. 6,000. Please compute debt to equity ratio now. Total debt.
So please, how
2,000
did you
divided.
get 2.5 for share capital? The 2 million plus 2.5.
Okay, I asked. Somebody even answered me in the classroom. I said, we are going to issue new shares via rights, Abby.
Yes.
Okay. We are going to repay the debt by how much?
2.5.
2.5. Where is that money coming from?
Okay.
Right issue. We are going to issue new shares. We are going to generate 2,720,000, out of which we are going to pay issue cost. That means by issuing new shares, your equity will increase by 2.5 because you will have repaid, you will have paid the issue cost. Your equity will increase by 2.5 million. Your debt will reduce by 2.5 million. It's just like saying you are bringing in more equity, reducing the debt. Is that clear, please?
Yes, sir.
So equity is reduced by, debt is reduced by 2.5. Equity will increase by 2.5. So you can now compute your debt to equity ratio. Debt over equity multiplied by 100 over 1. 2,000 divided by 6,000 multiplied by 100. That should give you like
That's 3%.
33%. 3,250 divided by 6,000.
54%.
What has happened to debt to equity ratio? What has happened to debt to equity
Significantly
ratio?
come down.
Thank you. You now comment here again. Look at it. Comment. By issuing new shares via right issue, and using the proceed to redeem existing debentures, the company debt to equity ratio will significantly reduced. An indication of reduction in the financial risk, in the level of financial risk of BG. This further confirms that rights issue is an attractive source of finance. This further confirms that rights issue could be an attractive source of financing. We have tested the impact on debt to equity ratio. We now move to interest cover ratio. Now come here. Effect of rights issue on interest cover ratio. What is the formula for interest cover ratio?
PBIT divided by interest paid.
Come here. Our interest cover ratio, interest cover is equal to EBIT divided by the interest expense. So we are going to calculate, we need to get the EBIT. We know the calculation of EBIT now. Look at it, calculation, our first working. We can continue. Calculation of earnings before interest and tax. Start with the current profit after tax. Current profit after tax, if you recall, is 1,050,000. If you have profit after tax, that implies that you have deducted tax, you have deducted interest. Is that not, please? If you have your profit after tax, that implies that we have deducted our tax and we have deducted the interest expense. So we need to return back the tax, we need to return back the interest expense. What is the tax rate?
30%.
30%.
Good. I can come like this. Our tax rate is 30%. So if you want to get profit, if tax rate is 30%, that means profit after tax is 70%. If I want to return it back, I want to calculate profit before tax. This becomes profit after tax divided by 1 minus the tax rate. You can use this to get back your profit before tax. Look at it. My profit after tax is 1,050,000 divided by 1 minus the tax rate is 30%, 0.3. Please work this out. It will give you profit before tax. Please work this out.
1.5 million.
That means the profit before tax is 1.5 million. If you want to be sure you are correct, compute 30% of 1.5 million. That will give you 450. 450 less 1.5 less 450. It will return back to you profit after tax. So you have gotten your profit before tax. What next? Add your interest. Remember, we are trying to get profit before interest and tax. The interest. The interest expense. We have debenture interest. Debenture is 12%. Total debenture is 4.5. Please calculate interest on debentures. We also have overdraft interest. Overdraft interest is
540,000.
This will give you, this is 540. Overdraft is 7%. Multiplied by 1,250,000. What is the interest on overdraft?
$87,500.
87,500.
So the total interest, please sum the two.
627,500.
627,500. You can now add back to your profit before tax. That will now give you profit before interest and tax. That will give you profits before interest and tax. Please add back 1.5 plus 627,500. 2,127,500.
500.
You can compute the current interest cover ratio. Current interest cover ratio. This is profit before interest and tax, 2,127,500 divided by the interest expense. Total interest is 627,500. This is the total interest here. 627,500. What is the interest cover ratio currently?
3.39.
Approximately 3.4.
Approximately.
Yeah, thank you. 3.4 times. What is the industry standard for interest cover ratio?
6
6 times.
6 times.
6.
That means this company is below. Sector average is 6 times. That means this company is not having sufficient profit, sufficient operating profit to cover its interest expense. You have gotten the interest cover ratio currently. We now calculate revised interest cover ratio.
It's after the rights.
Yes, thank you. After the rights issue, what is the interest cover ratio? That will become our revised interest cover ratio. Now you do this. After the right issue, our interest expense becomes the interest expense. The interest expense, so we are going to repay debentures by 2.5 million. That means our debenture is now 2 million. Is that not, please?
Yes,
Is
sir.
that not, please? So the
Yes.
debenture interest is equal to 12% of 2 million. That will give us 240,000. Overdraft interest. Overdraft interest is 7% of 1,250,000. That will still give us 87,700. That means the total interest is 327,500. We have gotten the revised interest expense. Now, you don't need to recalculate earnings before interest and tax. It's not a must to recalculate your earnings before interest and tax. Whether before right issue or after right issue, the earnings before interest and tax will remain the same. Let me take that again. Whether you look at it before the right issue or after the right issue, the earnings before interest and tax will be 2,127,500. Why? Why would this not be affected? Why would this not be affected? Now, let me take you back. If you prepare your cash flow statement, under your cash flow statement, you have operating activities, you have financing activity, and you have investing activity. Your operating activities will give you your profit before interest and tax. And whatever happens at the financing activity, by issuing new shares to repay debentures, is a financing activity. You are bringing in more finance, and you are bringing in more equity, and you are reducing the debt. Your financing activity items will not change the operating activities item. So it's not a must to recompute the earnings before interest and tax. But if you are in doubt, if you don't understand that aspect, in exam, once you have gotten your earnings before interest and tax, just pick it and move on. whether before right issue or after right issue. But if you want to give yourself comfort that I want to check this thing out, you can now recalculate. Remember, what is the revised profit after tax that we calculated? We have 1,260,000. Can we record this?
Yes, sir.
Good. Now that means we have deducted tax. I can now calculate revised profit before tax. This is equal to profit after tax revised 1,260,000 divided by 1 minus the tax rate 0.3. Please work this out. What is the revised profit after before tax? Please work this out.
1.8.
1.8.
Now you have 1.8 million. Now add the revised interest. Revised interest expense. We have computed. Total is 327,500. That will now give you your profit before in add back. That will give you your profit before interest and tax. Revised profit before interest and tax. What do you have here? 2 million.
We're
2
getting the same
million.
figure as
127,500.
Thank you. I've just showed this calculation. You don't need to waste your time in exam recomputing. Your earnings before interest and tax is not affected by issuing new shares to finance the repayment of debentures. So you can now calculate your revised interest cover. Revised interest cover ratio is equal to earnings before interest and tax 2,127,500 divided by your revised interest expense. Our revised interest expense is 327,500. What do you have here, please?
6.5 approximately.
5
6
times.
times. 6.5 times.
What has happened to our interest cover after the right issue?
It's better by almost 100%.
It's slightly above the industry standard. So you can comment here. Oh, you can comment here. Please how to answer that requirement B. You can comment now. Your comments to say the interest cover ratio of 3.4 times is currently below the sector average of 6 times. an indication that the company has higher interest costs and indication that the company has higher interest costs. You can continue your comment. Indication that the company has higher interest costs. However, by introducing additional finance to rights issue, the interest cover ratio improves significantly, slightly above the industry standard. You can now comment to the examiner. This is the expectation of the examiner as regarding this question. This is the expectation of the examiner regarding this question. All right.